Hey everybody, my name is Marcel Kalinovic. I'm the Butcher of Wall Street. Welcome to the Think Tank. This video is the next in a series exploring the macro and geopolitical implications on global financial markets. Join us for absolute destruction of global equities markets. Let's take a quick look at it right now. Hello everybody, thanks for joining me in the chat. It's great to see all you boys and girls. Welcome once again. Well, what do we have here? I'm here with all my friends in the think tank. We're all hanging out, having some discussions about everything going on right now with Russia and Ukraine. All of us here in the think tank. We were just talking about, meme stocks and silver, precious metals, gold, even palladium, things like that. Real estate, DRV, for example, the SPY, VIX, all sorts of fun stuff. So thank you for joining us, everybody. Taking a quick look here. This was found on Reddit. I don't remember exactly who found it or who posted it because it was posted in our think tank. But in my opinion, this is one of the absolute most disgusting charts that I've seen on the 2-year note. The 2-year notes, Treasury notes, collapsed almost entirely here back in 2000, which was the tech bubble burst when it began. Again, during the Great Recession of 2007, well before the market crashed. And as you can see, this time around today, it looks like it's quite accelerated in dramatic fashion. That's absolute demand destruction right there. On the 2-year note, look at the 5-year note. Looks very similar as well. The 10-year, the 30-year bond, just absolutely collapsing here. Today, Ford. Peter Schiff has just given me a quick heads up on Ford is being down 11.5% today. I ran out and bought some puts on Ford because they're going to come out with earnings and likely announce a massive miss in earnings, much in the same way that FedEx did just what was it, a few days ago, late last week, Zoombach, and we watched FedEx dump around 32-33% before their announcement, and then even more so in after hours. So total, they were down 35% throughout the day or such. Now we're Ford. Cue the fire, Johnny Bravo. Ford is down 11.5% so far today, and as of just a little while ago, I was checking them out. They were down around 13%, give or take, and they haven't even made their announcement yet. They are slashing production, cutting costs, and raising prices to cover these rising costs. What does that mean? It means layoffs. It means potential bankruptcy again, just like in 2007. The used and new car markets are absolutely collapsing. Inflation on these vehicles remains extremely elevated, but the number of people that are defaulting on their loans is ridiculously high. There are more people defaulting on their automobile loans right now than we have seen since 2007, 2008. And the reason being because car loans, in a way, here in America, are the new subprime mortgage crisis. But that doesn't make that real estate safe, not in the United States or Canada, China, Europe, anywhere around the world. We're seeing massive, massive problems with real estate, you guys. Peter Schiff even said Ford is likely headed for bankruptcy and GM, General Motors, will likely go bankrupt again. And if the Fed doesn't pivot, there will be no money to bail them out. What do you think this would do to the cost of cars if Ford or General Motors go out of business? It's going to absolutely skyrocket the cost of cars because there will be less in production, even more so than there are now. Take a look at Canada. Canada's August CPI, as we like to call it, because we all know the CPI is a fucking lie, is still up 7% versus the 7.3% that was expected. 7% gains on CPI on the 12-month change. And the Bank of Canada has come out to state that they are going to continue to do whatever necessary to restore price stability. The Bank of Canada Department of the, Boudreau, whatever his name is, said that the numbers indicate that we're moving in the right direction, but I still think August's inflation of 7% is too high. Absolutely. As we've told you many times on this channel, the calculation for CPI has been changed time and time again. Using the former calculations that we were using in the 90s, CPI right now in the United States is in the double digits, close to or higher than 20%. Same thing with Canada. They are well over 16 to 18%, but because of the January 1st, 2022 changes to CPI, they're showing it as only 7% because they reduced the weighting of the calculation. Weight as in WEIGHT. The weighting of energy prices and gasoline on the CPI data. Therefore, by reducing the percentages of those that are implemented in the CPI calculation, they are able to make it look as if inflation is not as rampant as it truly is. The Bank of Canada also continued to say that the bank will do whatever it takes to restore price stability and keep Canadians confident that the 2% inflation target can't be met. What does this mean? This means there will be more rate hikes, more demand destruction, more people forced to be unemployed, more people to lose their homes. How do I know that? Well, ladies and gentlemen, the higher these interest rates go up, the more that these adjustable rate mortgage rates go up. A lot of people in Canada, 53% of people in Canada that are homeowners have adjustable rate mortgages. These are balloon mortgages. They stay the same for the first 2, 3, or 5 years, and as they mature out of that fixed locked-in rate, they go to market rates. That means that these guys might have 2.5, 2.6% interest rate right now, and next month or in 2 months or 3 months, everybody's loan is different, right? And there's many people in Canada that are homeowners. 53% adjustable rate balloon mortgages are going to skyrocket. Their interest rate's going to jump from 2% to 6%, 6.5%, 7%. And that's going to be, I can't say exactly how much per home, but say on an average home that right now, if someone's paying around $2,000 a month in principal alone, that will go up to around $3,200, $3,300 a month in principal, not including interest, mortgage, PMI, and taxes. So a lot of people that can barely afford their home right now on adjustable rate mortgages, which is a lot of the reason why people take out these balloon loans, because they can't afford the fixed rate at 30 years. They hope to refinance when the time comes right. They're going to miss that opportunity because they can't refinance from a 2% to 6% because they don't have enough income. They do not make sufficient money to meet the qualification criteria in order to do so. I am a former real estate broker. I know these things quite well. I've dealt with them many, many times. And when interest rates change even a little bit, some people are priced out of homes. But when you triple the interest rate on somebody's mortgage, there's no fucking way, unless they make buku bucks, that they're going to be able to afford to either refinance or to keep paying the mortgages. That means that these people, now that COVID is no longer allowing deferrals of mortgages, these people are going to default on their loans. And they're going to be out on the streets, living out of cars, and their home will be sold at auction to the highest bidder, which is most likely going to be companies like Blackstone and BlackRock and Vanguard and such that continue to buy up these homes at all costs. Check this disgusting fucking chart out. Absolute disgusting. This is the Vanguard FTSE All World ex-US ETF, unadjusted. Okay, and so look at what happened back in 2018 when the Fed was forced to pivot in order to bail out the reverse repurchase program market. Okay, the one rate hike by the Fed dropped this in a massive way, up from 58 down to 43. The Fed was forced to pivot because the RRP, the reverse repurchase program, rate to borrow, cost to borrow, exploded from 2% to over 12% in a matter of a couple days. Therefore, the RRP had to be bailed out by the Federal Reserve and taken over by them. At the time, there was only a few $1 billion in it. A few billion. No, not even. I'm sorry. A few million. A few million. We're at a point now where there's 2 trillion. Sorry, hang on a second. We can look up the RRP. But it's at $2.222 trillion today, with around 93 different counterparties. 93 different counterparties. So you see what happened here in 2020 during COVID? It went from 53 all the way below 36. And now we've had an attempted soft landing by the Jerome Powell and the Federal Reserve that's absolutely not going to work. We have seen the destruction here on the VEU go from 65 down to 47. And the equity put to call ratio has not spiked in the way that it did back then. What does this mean? This means we've got a long way to drop here, and we need to see a massive, quick movement in this sort of ETF before things will turn around. This isn't even close to hitting the bottom. It's got a long, long way to go. Big shout out to Suburban Drone on Twitter. Thanks for the chart, buddy. One thing I'd like to note to everybody right now is if you go on and use your market scanner and look for the top gainers, you will see that the top 10, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, exactly. The top 10 stocks that are the top gainers today do not have contracts. Maybe Sava Sciences does. Sava Sciences does. Nope, they do not allow call contract purchases. Why is that? Because stocks like Sober, Ampex, Laxer, NRBO, Virax, Sava, Meds, MGAM, CRKN, QBTS are all pretty much pink sheet OTC bullshit. There are no options on them because the stock price is too low. Saba is at $39 now, but there's still no options available on it because it's run so hard. It was at one point here an OTC penny stock. In my humble opinion, I'm not a financial advisor and this is not financial advice, but the only explanation for this would be that all of these stocks are being used and abused by market makers, short hedge funds, family offices, and prime brokers to pull a profit. They are pump and dump stocks. And they chose them because there are no options available. So you and I wouldn't be able to go in there and get massive leverage by buying these options. We would not be able to because they don't exist. So we'd have to go in there and buy shares. Therefore, significantly reducing our opportunity to make serious money off of them because we cannot buy call contracts. If you don't understand options, basically it means a huge, huge leverage. And by taking away the opportunity for retail to buy options on this, it takes away the opportunity for us to follow in their lead unless we spend huge amounts of money on these shares themselves. Okay? But Bluebird Bio actually does have call contracts, but there are a lot of stock available to short. So although it does seem, in my opinion, like this was a short rally on Bluebird Bio, which we talked about a couple months ago, and it did really well. At that point, there was it squoze pretty nicely, and there was almost no stock available to short. And it was fun buying those call contracts, that's for sure. Made a lot of good money, and I reinvested it in my favorite stocks. That it sure as fuck isn't Bluebird or blue chip stocks. Let's put it that way. No relation there. Bluebird just happens to be the name of that ticker of that company. So this is a clear indication, in my eyes, of absolute desperation and money grabs, attempts for liquidity to get people to FOMO into these stocks so that they can take out puts and then drive them down into the ground by shorting them after they've had their little short covering rally and made a bunch of money. made a bunch of money off of them and are able to make money on the way down, leaving retail to hold the bag. Hold the bag. That's why the top 10, literally all 10 of them, do not have any options available to purchase. I've clicked them all one by one and I checked. There's a button here that says options chain, and it's not there because of that very fact. But as you can see here on Bluebird, you can see the options chain here. There is a button for it. The others do not have that. Let's see, Ampex, no options chain. See, it does not exist. I will show you one more time just to prove my point on Laxer. No options chain. No stocks no short stocks available. They cannot borrow a single fucking share. Okay? Because there are none. So that's why this OTC SPAC, it's a special purpose acquisition company, is running for these market makers and hedge funds to, and I allege that they're using these stocks to launder money and to make money. Plain and simple. This is a desperation money grab. I'm not going to dwell on this any further. If you have questions, drop them in the chat, and I'll try to take a peek at them and answer any questions you might have. This was just posted about 30 minutes ago from the New York Times. Russia is going to annex Ukraine, and they're going to annex portions of Ukraine. They are staging annexation votes, and the United States is calling them a sham. Why would Russia annex Ukraine? Because if Russia annexes certain parts of Ukraine like Donbass and Donetsk, much in the way that they did with Crimea back in 2014, if Ukraine attacks those regions, the Kremlin could use the votes to justify absorbing the occupied parts of Ukraine and escalate the war. What does that mean? Putin could use nuclear weapons without recourse. Right now, the only thing stopping Russia from using nuclear weapons is that this is a special operation. It is not a full-blown war yet, as far as Russia is concerned. Therefore, they cannot use nuclear weapons based on their way that their systems are set up. It takes 2 people in Russia to launch a nuclear warhead, along with Putin. So that's 3 people total. And in order for that to happen, these parts of Ukraine need to vote for annexation. And when they do, if Ukraine attacks Donetsk or Donbass, for example, Vladimir Putin will use nuclear force in Ukraine. They absolutely will. And that would immediately destroy markets. Immediately, unequivocally, inevitably, unstoppably demand destruction across the board. Markets would tank faster, farther, and harder than you ever saw during COVID, than you ever saw in 2008, than you ever saw in 2000. It's going to make those things look like child play. 165 on the SPY, in my opinion, is incoming. You heard me right. 165 is incoming. This is a speech that Putin gave not too long ago. It was a few weeks ago. And he says, I want to emphasize again that all responsibility for the possible bloodshed will lie fully and wholly with the ruling Ukraine regime.
Возможное кровопролитие будет целиком и полностью на совести правящего на территории Украины режима. Теперь несколько важных.
Says, I would now like to say something very important for those who may be tempted to interfere in these developments from the outside. No matter who tries to stand in our way, or all the more so create threats for our country and our people, they must know that Russia will respond immediately, and the consequences will be as such as you have never seen in your entire history. No matter how the events unfold, we are ready. All the necessary decisions in this regard have been taken. I hope that my words will be heard. And he calls on the citizens of Russia to say that the cultures and values, experience, and traditions of their ancestors invariably provided a powerful underpinning, and the very existence of entire states and nations, their success and viability. This directly depends on the ability to quickly adapt to constant change, maintain social cohesion, and readiness to consolidate and summon all the available forces in order to move forward. Now, a lot of people will state the obvious, that Russia may not be able to handle such takeover of Ukraine or invasion of NATO alone, and that's probably the case. But there's no doubt in my mind that Putin will get countries like Chechnya and Syria and Iran to likely join him in this escapade. Very, very likely. In the same way that people thought that Putin could never attack Ukraine, that he would never attack Ukraine, the same thing people are thinking about nuclear war. The same thing they say about Putin not getting help from Chechnya, Syria, Iran, and other Middle Eastern countries and Eastern European countries. He absolutely will. In the same way that people thought that Russia would never invade Ukraine, people think that China will not invade Taiwan. Ladies and gentlemen, it's only a matter of time. And at those moments, we will see absolute demand destruction all across the board, including financial markets. This is something that is absolutely already affecting us, but it has not been enough to change things significantly. Look at home buyer mortgage payments. Look at home buyer mortgage payments right now. In 2022, they are about as high as they've ever been. There was a slight retraction on them. They are up over 42.5% from last year. A mortgage payment on a 4-week rolling average of the median asking price is absolutely monstrous. Monstrous. And the most people don't understand anything about what's really happening. Putin will annex parts of Ukraine. He's going to wheel in the fucking nukes and he's going to park them there. And when they get attacked, he will use nuclear weaponry on Ukraine soil to defend these annexed portions of Ukraine, which are technically Russia. For those of you that don't understand, Ukraine didn't properly secede from Russia. They were supposed to file all sorts of documents with NATO and with Russia, and they never did. They just said, okay, we're done now. And that's not the way that things work. Like it or dislike it, that's not my opinion. Those are facts. Those are absolute facts. Russia has not recognized Ukraine as its own country ever, in the same way that China has never recognized Taiwan as a separate country. They see them as parts of their own, because technically they are. Again, this is my opinion. These are facts. These are facts. Look it up for yourself. Do some more research if you think I'm full of shit, because I'm telling you the absolute truth, unequivocally. Putin was supposed to make a speech today, which has been postponed until tomorrow. And I think that is going to really shock a lot of people. A lot of people. Hang on 1 second while I get something else out here. Where did I put this? Sorry, I had some awesome charts I wanted to share with you guys. Let me just bust it out here. Give me one moment. Yeah, guys, you're absolutely right. Omantha, I think I've answered that question about how does it make MOASS about a million times. And I don't really know how else to explain that at this moment. I can, but that's not what this stream is about. This stream is... I'll get to that at the end here. Don't get me wrong. But this stream here is directly related to the issues that we're seeing on our markets. Mortgage payments have increased 42% over the last year from $1,675 to $2,385. And that's just here in the United States. Then you've got builder confidence. Look at the Wells Fargo Housing Market Index. Builders' confidence is dropping massively. I've been watching new homes in very, very popular places around the country like Texas and Florida and California just losing massive, massive amounts of value. This is the ninth consecutive month in a row, that we've seen housing prices drop for new homes. This is the lowest level since May of 2020 for the home builder index. The blue line is the housing market index, basically the sentiment of these builders, and the red line is single family starts, new homes that are being built. As you can see, that's on its way down, ready for a significant retraction. Here are those home values I was just telling you about. This is the Zillow Home Value Index, okay? And that shows that the home values increased ridiculous fashion after 2008 because of the Fed pivot and printing of trillions and trillions of dollars and buying up trillions of dollars in mortgage-backed securities. The Federal Reserve owns $2.8 trillion in mortgage-backed securities. That is a huge, huge bubble that has been propped up specifically by the Fed. Now housing prices are at $356,000. You see it's just like ever so slightly starting to curve downward. Yeah, that's what this was like. But the Fed is not going to be able to just turn around and start printing money like they did in the past because they're trying to curb inflation. They're not going to be able to lower interest rates like they did in the past because they're trying to curb inflation. This must continue. They will put people out of a home. People will be unemployed. People will lose their homes without question. This is month over month right here. You can see it already on the zoomed in scale start to plummet. Buyers contributed to the largest monthly drop in home values since 2011. And it's going to get worse. Check this one out. Here, my friends, you have, this is inflation and their levels around the world. These light blue ones are energy, durable goods, non-durable goods, services, and housing. You can see energy inflation is extremely high, including durable and non-durable goods. Even services are really high because they have to pay for things like gasoline and energy and durable goods to fulfill those services on your behalf. That's in the United States. Look at Europe here. Energy and food influence. Energy is through the roof. Okay, absolutely. Non-durable goods, food and such, through the roof. Durable goods is also even higher. Japan. Deflationary elements are taking place in Japan. This is also as bad because their dollar is being significantly devalued. Significant devaluation of the Japanese yen right now. And China, they're below target even with a food and energy spike. They are below target because China, even today, continues to print massive, massive amounts of money because they have no choice. The Chinese real estate market is in absolute free fall, and they are doing everything they can to prop it up. It will only last so long. Over 40 central banks around the world have hiked rates by at least 0.75 percentage point, by 75 basis points in one shot since the start of 2020. Look at all that red. And we've got another one coming tomorrow, either 75 or 100 basis points coming tomorrow during the FOMC meeting at 2 p.m., I believe, is the meeting minutes. The United States financial conditions are tightening since the beginning of this year. Make sure you can see that on your screen. Okay, yeah, you can. I will move this up just a smidge. Check that out. This is what happened back in 2008. What does that mean? Margin calls, collateral crunch, liquidity crisis, bank runs, financial runs. People will be taking their money out of banks and stocks and bonds and equities. They're not going to flock to bonds like they did back in 2008 because the bond yields are fucking collapsing. And they're not going to turn around this time like they did in 2008 in a positive fashion. They're not going to. This is going to be the most disgusting fucking depression we've ever seen in our lives. And I'm sorry if I'm being a little negative here. That's not my intention. I'm a very optimistic person. I'm very positive, but I'm being realistic here. I remember the crashes of 2020 and 2019 and 2016 and 2014 and 2011 and 2008 and 2000. I remember them really fucking clearly. I remember doing real estate during and after the 2008 crisis. I remember how hard it was to sell homes afterwards. I remember selling just one home, but renting 56 apartments in 1 year. Because nobody could afford homes. Nobody had the credit. Nobody had the ability to buy some. And that one home that I sold, it was a short sale. It was a short sale because the sellers were desperate to get out and trying not to declare bankruptcy. And the other 56 apartments that I rented that year were rentals, obviously. What else do I have to say about that? This is the evolution of the global GDP. In the event of a recession, global GDP would not reach the level predicted on pre-COVID trend for 2024 until somewhere around the end of 2020s. We wouldn't get back to the global GDP that they're projecting until 2030. 2030, ladies and gentlemen. How long do you think it's going to take your 401k, pension, IRA, and thrift savings plan and ISA to recover if you don't make the right movements? It's going to take over 10 fucking years, in my opinion. We have revised down our GDP forecasts, says Goldman Sachs. Why would they do such a thing? Well, because they understand that a global recession is underway. The CEOs of FedEx and UPS have come out and said that they predict a global recession is around the corner. I have been telling you since last fucking August that a global recession is around the corner. But now finally, when everything's falling apart, people aren't looking at the signs, they're looking at what's already happened. Just like the Federal Reserve. They're looking at data in the past, whereas we are looking at data in the future based off of the historical things that have occurred in the past. Past history does not equal future performance, but it sure as fuck is indicative of what's possible. Jesus fucking Christ. And for those of you that don't know, the Atlanta Fed has been significantly reducing their forecast every single month. Every single month you've seen the Atlanta Fed come around and reduce it. It's down to the point where Citigroup now is even forecasting only 1.8% GDP growth for 2023, for Q3 of 2022. Wait till you see what Q4 looks like, ladies and gentlemen. Wait till you see what Q4 looks like. And this is just a forecast, obviously, because they don't actually know what Q3 is going to look like. You're going to see it come out from the Atlanta Fed and such that it's actually significantly lower. This would be the best case scenario for bringing down core inflation and increasing GDP growth, increasing jobs and wage growth. They want below potential GDP growth to lower the jobs and workers gap, to slow down wage growth, to bring down core inflation. They want you to have less money. They don't want your money to keep up with inflation. They don't want you, they want to reduce inflation by reducing your fucking wages. Check this out. What do you expect the peak level for the federal funds rate to be in the current tightening cycle? The 44 economists were surveyed from September 13th to 15th of 2022. And a lot of them are expecting a peak of 4 to 5%, which is absolute nonsense. The Fed is going to have to go way higher than that. 18% are predicting 5 to 6% points, a peak level in the current tightening cycle. Now, that's just right now. So that means some of these guys are pricing in 100 basis points, whereas these guys are just pricing in 75 basis point increases at a time. Economists surveys expecting unemployment to top 5% in the next recession, which they believe will start in the first half of 2023. And I will argue that they are absolutely, completely wrong. This recession has already begun. This is something that began a long time ago. So as you can see here, a lot of them are predicting 5 to 6% unemployment, some 6 to 7%, some 7 to 8%, and a few over 9%. I'm kind of in this boat. I'm kind of in this over 9% unemployment prediction here during this coming recession. Goldman Sachs thinks that the decline in consumer inflation expectations should reduce fear of unanchoring and supporting the case for slowing the pace of hike after September. This is the University of Michigan survey of consumers' median inflation expectations over the next 1 year. It is absolutely massive. This is the New York Fed survey of consumer expectations over the 1 year ahead. It is also massive. The problem is that consumers don't know shit about inflation. In reality, it's much worse than they actually believe. And I've proven this to you in other videos that we've done in the past, that inflation is always higher than the consumer sentiment believes it to be. This would be the New York Fed Household Spending Survey. This is the New York Fed Household Spending Survey here. This is August of 2022. This is the median expected monthly overall spending growth over the next 12 months. It's going to be at 4.4% in August. Expectations. Look at the dispersion. It's as high as 9% for some. Unfucking believable. What is real wage growth? It's expected to be near nothing, 1.5%. How is your 1.5% increase from a year ago in wage growth going to protect you from 9% inflation, which in reality is around 19 to 20% inflation if you use the calculations the same way they were back in the 1990s, before the Fed started to significantly change the weighting of CPI. Corporate yield. Corporates, America is making the most money it's made since 2009 off of your back, off of you. The corporations are making the record profits that we're seeing today. Obviously, the profits aren't as high as they were back then, but look at the U.S. IG corporate yield is the highest since 2009. This is what it was in 2008. And we haven't seen these levels since 2009 because corporations are making a lick off of us. Global government bonds are on the track for the worst annual loss since 1949, ladies and gentlemen. This is the worst bond rout in history. And if we're on the way to the worst loss in 1 year since 1949, it's only a matter of time, a few months here, if not sooner, since we see the largest collapse of bonds, world government bonds, as far as GDP weighted returns on an annual change that we've seen since the Great Depression of the 1920s. A lot of people, sadly, are going to die and lose their homes, starve to death, not get sufficient health care, not be employed, and there's going to be a record number of people working 2, 3, 4 jobs just to try to catch up on their bills. I don't even have to pull up a chart to tell you guys that I know for a fact that credit card debt is at an all-time high. Never in America has credit card debt been higher than it is right at this very fucking moment. Never. Never, ever. That's a really telling sign. I think that really explains a lot here on what's going on. This is the S&P with and without OPEX, options expiry. SPY shares worth $1,000 bought at the end of last year would be worth $811 today. On the other hand, an investor who bought $1,000 worth of SPY shares at the end of last year but went to cash during each of the OPEC weeks this year would have $998, almost flat. That's why options expiry is so important for market makers and hedge funds and the Fed, etc., etc. Look at insider transactions. Insider transactions here. Rate of insider sales to buys. Higher is sells, lower is buys. As you can see here, many insiders across the SPY, across the S&P, New York Stock Exchange and such, and around the world, have been selling off. Readings under 12 to 1 are bullish. Those over 20 to 1 are bearish. Here in September, we have seen it go over 30. The last time we saw that was November of last year, right before, November of 2021, right before the all-time highs that we saw in December, and the market started to tank. And of course, January of this year. Check out the US dollar. This is the S&P 500 Foreign Revenue Exposure Index, which is divided by the S&P 500. The strong dollar poses major problems for United States corporations that have big foreign sales. Their foreign sales will tank. Excuse me. So as the dollar is rallying, you're going to see a reduction in the stock market. The strong dollar is bad for the stock market because countries and companies outside of the United States, obviously, that do business with the United States will not be able to afford to buy or to import as much as they used to because of their diminished purchasing power and the fiat. So the stronger DXY, the higher the yields of bonds, the lower that the stock market will actually go. But until then, the Fed and the plunge protection team will continue to buy and create as many swaps on Forex markets to manipulate the prices as much as possible, suppress the volatility index, also known as the VIX, and to pump the SPY in an attempt to create a soft landing, which at some point here, if it's not Chinese real estate, Canadian real estate, European real estate, something is going to crash. It could be the reverse repurchase program market, just like we saw it in September of 2019 when the Fed had to bail it out. They already bailed it out. They can't do anything more. As a matter of fact, Bloomberg is already talking about that the Fed is considering reducing the RRP and the ability for these guys to use the RRP. That would mean that money market funds are the vast majority of the RRP, and hedge funds and such and other banks and prime brokers, family offices, etc., would not have the RRP to stash their money in overnight. It would be absolutely wonderful for short squeezes. Margins are under pressure. They're at all-time highs, and they are vulnerable to downgrades. This is directly from Goldman Sachs. I quote, "Margins are at all-time high, and we think vulnerable to downgrades." So if margins are downgraded, that means margin calls. Margin calls. Here's Morgan Stanley talking about margins being under pressure. Morgan Stanley's Michael Wilson observed that the divergence between rising labor costs and slowing demand is sending a bearish signal for profits. The source here is Haver Analytics, Morgan Stanley Research. Demand equals the average of the score of economy to improve. Higher real sales, higher earnings, raising prices. And wage cost is the average score of planning to raise worker compensation and cost of labor, being the most important problem. This is the NFIB Small Business Survey Demand Composite in blue. As you can see, the Small Business Survey Demand Composite in blue is tanking. I'm a small business owner. I own several small businesses, and demand is down. I will be the first to tell you. Look at the wage cost composite. Wage costs absolutely started skyrocketing. And the only reason they've started coming down is because there are more people unemployed. Therefore, more people willing and more people out of the workforce. Unemployment numbers are down because a lot of people have left the workforce and have not looked for a job in 4 weeks. If the Fed called you, the company that does the surveys called you, the NFIB, and they asked you, hey, did you look for a job? You're unemployed? And you say yes. When was the last time you looked for a job? And you say 5 weeks ago, you are not considered unemployed. You are considered out of the workforce. Because if you have not been looking for a job in 4 weeks, you are not unemployed according to them. Therefore, you go off the unemployment numbers, get put on the out of the workforce numbers, and the unemployment numbers look fantastic. Ladies and gentlemen, you're being fucking lied to every single day by your very own government. The government doesn't fucking care about you. They don't care about me. They don't care about any of us. We are fucking pawns to them. S&P 500 net margin year over year, 2022 was absolutely huge. The small business survey demand versus wage cost composite in blue is tanking as well. And these margins will have to come down. They will have to come down, but it's going to be a destruction of equities markets. These are financials right here. The return on equity, okay, the return on equity here for the S&P 500 declined quarter over quarter for the second time this year. And financials were the major reason. Look at financials right here. They're at 11.6%. Okay, look at how fast how quickly they started to drop in 2022. Look at the S&P 500. It's at 21%, also making a severe downturn. Look at what happened the last few times they had a little bit of a severe downturn. And this was here in 2008, 2009. Look at what happened to financials. It went from 15 to negative 10. Right now, we've just barely gotten started. I could easily see this going from 15 down to negative 15 or worse. Easily in my eyes. That's the second time this year, as of the second quarter of 2022, that we're seeing this. These are put to call ratios of 1.5, historically being a turning point for the S&P 500. When we have a put to call ratio of 1.5 and above, which we are seeing right now at 1.509, see that? What happens? What happens to the SPX? Look, last time it happened here was 2020 during COVID. It fucking jumped above 1.5 and we went down way the fuck down there to sub 250 on the SPY. What happened back in 2019 when the RRP collapsed? The put to call ratio spiked over 1.5 and we dumped way the fuck down here. Even in 2018, it slightly happened. But now, ladies and gentlemen, look at where the SPX is. It doesn't even fit on my fucking screen. Let me try to adjust this so you guys can get a better look at this, because this is the most disgusting, most clear thing I have ever seen as far as it goes for the overvaluation of the everything bubble. This is where we were during COVID. And the government came out, printed tons of money, gave you $1,500, and gave banks trillions and trillions of dollars. And they bought trillions of dollars of mortgage-backed securities and trillions of dollars of United States treasuries $2.8 trillion of mortgage-backed securities to prop up the housing market. 6.3 or so, $6.5 trillion worth of United States treasuries. 6 trillion. Their balance sheet is $9 trillion. Look at where the SPX was at the beginning of 2022. Look at where it is now. We've had all these bullshit bull rallies that we've had so far. We've had 1, 2, 3, 4, 5, 6, 7, 8, 9 or 10 bull rallies so far. In 2008, we saw 8 bull rallies. In 2000, we saw 8 bull rallies. We have already seen 10 so far this year. I think we're almost to the finish line. And this has a long way to go down. And it's going to be a steep, severe drop, much worse than this. I foresee 165 coming on the SPY easily. Easily. Real estate is the only sector that's seen an increase in buy ratings. The only thing that has seen an increase in buy ratings. From September 2022 versus February of 2022. September's the light green and February is the dark green. So you've got energy here looking pretty healthy, but it is down further. And real estate is the only one, because this number is down, it's showing more buy rating percentage-wise. I know it looks backwards, but it's not. Down is good, up is bad on this particular one, on this particular chart. And volatility, my friends, volatility is the worst it has been since 2009, 2008. 2000 didn't even come close. The crash of 87 didn't even come close to what we're seeing now. 1937 and 38 and all that such, the decoupling of gold from the fiat, from the US dollar, wasn't this bad. The 1920s Great Depression and in the early 30s, the volatility breath was nowhere near what we're seeing right now. The only time volatility has been worse was in 08, 09, because it had already crashed. Ladies and gentlemen, we're already at 08 levels, and we haven't crashed yet. We've been playing this little game of chase where permabulls think that the market's going to turn around and we're going to go up to 500 on the S&P. You're fucking nuts. Fucking crazy if you think that. You're fucking stupid as shit if you think that, in my opinion. And again, I'm not a financial advisor, but I'd be willing to bet anybody, $1 million that the SPY will not go to 500 this year. Anybody. Grandpa Barney, thank you so much for your support, my friend. You are truly a legend. Thank you very much for liking, subscribing, and for contributing to the think tank. Thank you very much, my friend. 25% of all donations and contributions to the think tank do go to charity. I will do a video to show receipts and proof of how much we've given to charity in the short future. Right now, I'm on a roll over here talking about this crap market. Look at the earnings risk heat map. The overall score on the heat map for consumer services is absolutely in the red. Semiconductors, red. Technology, retailing, transport, commercial and professional services and materials, orange. Diversified financials, software, food and beverages and automobile components are right behind them, followed by energy and durables. The things that's going to be the overall risk score for banks being green on the earnings risk heat map potential, in my opinion, is an absolute fucking joke. It's an absolute joke because this doesn't take into account the hundreds of trillions of dollars of over leveraging that's occurring on these markets. Holy shit. Now,
so what you're saying is we're going to be rich as balls.
that's exactly what I'm saying. That's exactly what I'm saying. A lot of fucking people fail to realize that not everything is going to drop. Sure, in the short term, in the immediate term, everything will lose some value. Meme stocks, Precious metals will lose some value in the immediate short term. But in the long term, I'm sorry, not in the long term, but in the short aftermath, after a market crash, when collateral dries up, short squeezes are inevitable. Absolutely inevitable. Excuse me 1 second. Be right. Now, I would like to thank Occupy the Fed movement for this excellent post. He says, ultra-rich silver spoon BlackRock puppet Jay Powell is not a man you want as Fed chair right now. He intentionally caused this Fed inflation crisis. He wants it to go on for years. He doesn't give a shit about how inflation is destroying middle and working class Americans. The fight is a farce. And I have to completely agree with him. They knew that this was going to happen by printing all this money due to COVID. It was in the books. They didn't know how long it was going to take, but they knew it would happen. Now that we're here, they continue to push more things that cause inflation. Joe Biden passed the Inflation Reduction Act to increase inflation. You got that right, ladies and gentlemen. Just like they said it's transitory, and it's not. Joe Biden passed the Inflation Reduction Act to create more inflation, to print more money for Ukraine, to print more money for banks and other bailouts. It is the worst thing that could have possibly happened to us. As far as this administration doing anything to help us, they are absolutely trying to destroy the American middle class right now. And as of right now, we're seeing stocks like AMC and GameStop and other meme stocks absolutely being destroyed, absolutely being crushed. Because before they actually move up, they're going to come down with the market as far as possible to prevent margin calls from occurring on those stocks. And that's just a downright fact. And I'm okay with that. If you've been watching this channel for a while, you've seen me just last week. I bought hundreds of thousands of dollars of AMC and APE and AMC1 contracts and all sorts of other things. And today alone,
The lower they go, the worse the haircut.
yep, lower they go, the worse the haircut. But yeah, I've been on a bit of a buying spree today. Let's see, bought 10 BBIG calls, 200 AMC1 calls, 92 more, 8 more, 100 VIX calls. Let me see what else. I bought some Ford puts and a bunch of other things.
Man, those options are cheap. What a great deal.
Cheap as shit. Bought some Hycroft Mining Corporation calls. I feel absolutely bullish. AMC owns 25% of Hycroft Mine. Hycroft Mine recently, just last week, announced by CEO Diane Garrett, who we had on this channel a couple months back, along with my friend Pantheon AMC, it has discovered more gold and silver at higher quality than they ever imagined due to the most recent drilling that they've done. So they are in absolute great shape and prime to run. But before meme stocks go up, they're going to go down. They have to. Because if they don't, a margin call would happen immediately. And margin defaults would mean that these banks would lose more value. But they can only go down so much because stocks like AMC and GameStop, for example, all those shares that are owned by institutions, for example, BlackRock owning over 40 million. Yes, I can. BlackRock owning over 40 million AMC shares is lending them out, and they're using them as collateral against other short positions.
Oh, that's it. Yes.
Here you go, baby, my princess.
Okay.
And so with AMC going down below a certain level, I can't say if that's $8 or $7 or $6, doesn't really matter to me. The point is, at a certain level, it becomes more expensive for them to bring it down further because then their other short positions, of which AMC is a hedge against, those would be devalued further and they would be margin called on them because there would be a collateral haircut. Every dollar under $10 that AMC goes, it loses a percentage of collateral value. AMC now is AMC plus APE equals AMC1. This is why I continue to buy AMC1 call contracts, because AMC1 is the best thing since sliced bread, in my opinion. Because when you have AMC1, it is worth 100 AMC calls plus 100 APE calls. Therefore, sorry, thank you. You guys know what I meant, right? The one call of AMC1 is worth 100 APE shares and 100 AMC shares. Thank you very much, Cash. I appreciate you picking up on that misspeech of mine. Thank you. So I've got multiple. Thanks, dude. I've got multiple accounts here, and continue to have a blast buying this shit up on them. As you can see here, let me take a look and see what we're working with. Absolutely crushing a lot of these right now. Let's take a look here. This one account only has 50 APE shares, but my other accounts got several thousand. I'm in the 5-digit AMC and APE shares at the moment. At 1,400 AMC1 call contracts on this account at this very moment. And that is indicative of the underlying assets, which is 100 shares of AMC and 100 shares of APE. Therefore, for those of you that are unaware, there are multiple things going on with AMC, APE, and others. APE, there's basically a 90-day time frame that is coming here in the mid to end of November, in which APE shares must be delivered, and if they are not properly delivered, it gives Adam Aaron opportunities to force a share recall through the DTC. That would immediately cause shorts to have to close their position.
Yeah, baby, I forced cover.
It would force them to cover. They wouldn't be able to kick the can down the road because they would have to buy back the liquidation by the broker. So say IBKR is owed shares by Virtue or Citadel. IBKR, Interactive Broker, would then go out and tell them, okay, you've had your 90 days. I'm still short. We're closing out your positions. You're being liquidated. And it would be automatic. Automatic. It wouldn't be anybody's decision at what price to buy them back. The computer would just start buying them back. If somehow by chance they happen to move past that and that doesn't happen, there's a very good possibility, an extremely high possibility in my opinion, that the put to call ratio increases even higher than 1.5 than what it's at right now, which it has not been at since the market crash of 2020. As you can see here, it went up in 2020, and immediately after we had the COVID crash. So as this continues to rise, it's only a short matter of time before the market crashes, collateral has no value, the market margin calls go out, and the DTC will not be able to stop it because it won't be the DTC margin calling. It'll be the prime brokers margin calling the hedge funds, the family offices, and the short hedge funds, and retail investors. And it would be other prime brokers like JP Morgan margin calling Bank of America, who they leased millions and millions and millions of ounces of silver to who Bank of America has turned around and shorted that very same silver. There would be broker dealers like Robinhood and Webull and Interactive Broker and Charles Schwab and Fidelity forcing liquidations of short positions and failures to deliver on APE. There is an entire domino effect of things that's happening. Phase 6 initial margin requirements that began on September 1st forced banks to have billions and billions of dollars more in cash on hand at all times. And that, in turn, is leading to a further tightening of liquidity. Real Rugged DIY, big shout out to you, my friend. Thank you very much for your support. We appreciate you, my friend. Cynical Mailman, I don't believe it to be. If it's 90 trading days, that puts it in early December. If it's not 90 trading days, that puts it in mid-November. So these dates are not for any other reason except for educational purposes only. If you're a fucking idiot and you go out and make a purchase thinking that we're going to fucking run in mid-November or late December because of what I just said, you deserve to lose all your fucking money. I'm not here to give you financial advice. I'm not here to tell you what to do. I'm here to give you the facts and the statistics. And we've proven this on other videos from the DTC that we did with showing you the things from the Options Clearing Corporation, from the DTCC, stating specifically what I just told you about the 90-day liquidation period. Everything that we've talked about is straight facts, direct from filings from the SEC, the DTC, the OCC, and all these fucking assholes with, these acronyms. MC5, no, I appreciate you, my friend. Thank you very much for your support, everybody. TMI's baby mama, Tweak Trader, Cordy, Dana, you guys are the best. Appreciate the hell out of you guys. On that note, what does it mean for meme stock holders and precious metals holders? In the short term, you're likely to see a reduction in value. I don't know how much, I don't know for how long, but I don't think it's going to last very long. The short-term TLDR here is that we're going to be so motherfucking rich that we're not going to know what to do with it. And as I told you in the past, Janet Yellen has told us in front of Congress, testifying during the CARES Act, September 28th, 2021, that there are issues relating to hedge funds and the possibility of financial runs due to their over-leveraging. We've heard it directly from the old bat herself, old fucking Yeller. And that's why, my friends, I am the #1 fan and president of the Ken Griffin fan club. Ken Griffin, go fuck yourself. Pay me my fucking money. On that note, I'm done, ladies and gentlemen. This market's fucked. I'm going to be rich as balls. Good luck to all of you. I'm waiting for AMC to lose a little, AMC and GameStop and all these other meme stocks to lose a little more value, to drop another fucking few $100,000 in them, in which I will be more than happy to do. And in the meantime, I continue to buy every single fucking day. But don't take my word for it. Do your own fucking due diligence. Let me show you a little little map that Kenna from the Bull House did. Check them out on Twitter, Kenna, at the real Kenna. These are all ETFs that hold GME that can be manipulated at any time. These are ETFs that hold AMC and GameStop together. These are ETFs that hold AMC. And at any time, they could be inserted and removed from other ETFs in order to be manipulated. Because when there's no shares of them directly to short, they can go and short these ETFs, like IWM and such, and manipulate the price like that without showing short interest directly on the stocks. Directly on the stocks. So I want everybody to know, no, I am not looking forward to a market crash, but it is fucking inevitable. And I will position myself and my family in the way that I think is best. And that is through precious metals, both physical and COMEX and futures, and silver like SLV and PSLV. But I do believe that the silver papers, precious metals will be greatly manipulated at some point. But guess what can't be? My precious metals that are in physical form cannot be rehypothecated. They cannot be resold. They cannot be sold without being purchased by Bank of America to short them. I have them in my possession, as do many other people. And at some point, I could see silver going from $20 per ounce to $2,000 per ounce. I could see gold going. Get the goddamn money printer out, Jerome Powell. I could see gold going from $1,800 to $20,000 to $30,000 per ounce, without question. And so what I'm saying here is the market crash presents a very exciting opportunity for meme stockholders. Now, I'm not a financial advisor.
Transfer of wealth.
A transfer of wealth. That's a good way to put it. That is the scariest thing that these banks could ever imagine. And I'm saying that it is a very exciting opportunity. And I'm tired of pretending that it's not. On that note, Jerome Powell, get that motherfucking money printer out, because you're going to have to bail out all these fucking banks. And I know you're going to do it off the backs of Americans, just like you increased the pensions, the pension plans of the maximum cap that can be used of pensions to backstop the OCC. Now, here's what a lot of people don't realize. The Office of the Comptroller of the Currency is backstopped by pensions and such. And there was recently a filing that came out on September 8th where the Office of the, not the Comptroller of the Currency, wrong OCC, the Options Clearing Corporation Board authorized the OCC to seek up to an additional $2.5 billion in external liquidity, including through the non-bank liquidity facility, which would give the OCC access to $5.5 billion in external liquidity. That would come from insurance companies and pensions. But here's the kicker. In the event that the OCC is unable to obtain the full $1.5 billion from its bank counterparties, the OCC would source the full $2.5 billion out of the non-bank liquidity facility program. Here's the really, really important part, that a lot of people that read filings can read this portion and be like, oh, that doesn't say 35 trillion. You're wrong, Marcel. No, you fucking idiots, because this regulation change removes the present $1 billion funding limit to the non-bank liquidity facility program, sure. But what does it also do? It would remove one of the specified terms that could require the OCC to file an advance notice. This means that at any time, they could increase that cap from $5.5 billion to all $35+ trillion invested in pensions around the world. On that note, this market is fucked. Please protect yourself. We're going to be so goddamn fucking rich. Holy shit. Have a great day, everybody.
So goddamn rich.
I wish you peace and wealth. Fucking hell. You know what? I got a little speech from my man Wolfie. Because this is our time. We are the fucking whale.
I mean, we own it 5 times over.
We're the fucking whale. The fucking whale. Plain and simple.
Well, that's the thing when people talk about VW, they keep saying, oh, it's different, it's different. It is. Of course it is. But in some ways, I think it's stronger because you're dealing with people, say the majority, haven't had it. But I don't know any billionaires that have been buying shares.
Well, you know what's wild? Wolfie, the Porsche settled with the government in 2008 and said, all right, that's enough.
Yeah.
That was one whale. We are the mother of all whales.
Yeah, there's no settling with us. There's no settling with us.
Yeah, with us.
We're the board, man. You cannot reason with us. You know
Never
what I'm
thought.
saying?
Exactly.
We're going to assimilate you.
No matter how much they
That's
offer,
it.
there's going to be people saying, fuck that, I want double, triple, 5 times that amount. No matter
Exactly.
what they offer.
100.
They could
I
offer
wanna
100
see-
grand a share, and I guarantee you 40% of the people would be like, fuck you, I want 500 grand a share, you know? That's what
It's
they'll be
true,
like,
though.
it's GameStop, I want 2 million a share.
I want Wall Street to get turned upside down, and I want to see a bunch of motherfuckers who are literally evil end up on the fucking street. You know?
Same.
I can't wait for
I never
fucking
thought I'd be
Biden
so
to get
sad
on TV and
to be
stutter
so
away
fucking
and
rich.
say, all right, there's enough of this. Gary Gensler and then the Fed. It's going to be phenomenal. This is great. I love it.
They might try to sweep it under the
just
rug.
cracked
They
30.
might just try to sweep it under the rug and be like, oh, all these hedge
baby.
funds fucked us, let's never talk about this again, you know, and that's it. So,
Not me.
Well, that's why I
I'm
love
going to
the fact that it's
dance.
Between 5 and 10 million people. Because the eyes are on this, you know, the noise has been made.
eventually,
And when it comes out, you're going to have 5-10 million burries that have all got a tale to tell, and there's going to be serious questions asked to the regulatory bodies. What the hell happened after 2008, and why didn't you put the rule changes in 2012? And what do you mean the only thing you did of any essence was an SSR rule and then made market makers exempt? They're going to be serious questions. But then they got on the other side, they got a massive transfer of wealth to people that are going to have the time and be open to be able to say what they did, what their role was, what their part was. And then I'm hoping that's the big thing for me is change. 5-10 million people suddenly come into a serious amount of money if that's how it ends up.
We're gonna be so goddamn rich.
But if it works the way those who have, for the reasons they have, expect, I'm hoping that's going to really change. And when I look at the SEC rule changes, etc., that's what actually gives me even more. I know, a lot of people are down because it took so long and this, that, and the other. Not really seen it, but that's background. That DOJ announcement to me was massive. I think that's why people get nervous when people start saying, "Oh, it's going to." And we've had, I flagged it up, not that it got picked up on, but we've got real smart people that have been looking at this, real smart apes and DD done, etc. What if they was all meant to be correct? What if they were all correct, but because of everything going on in the background with the manipulation and the tricks and the market exempts and with all that going on, which is now known, I never knew none of this a year ago, 18 months ago. I never knew about market exempt. I didn't know they could do a naked share without a locate. And all this is coming out, and they're going to be serious questions saying, that's not liquidity. There's court cases, there's a paper trail going back 20 years on this stuff. None of this is new. And when it comes out, it's blown wide open. It's not, UK was told
$30 has arrived.
You ain't missed.
Go ahead, brother. You were making a great point. Keep going, brother. Preach it.
Go ahead.
Yeah, sorry, I just got cut off and then everyone pulled in, so I sort of lost trail. But it's that paper trail, which it's the aftermath of us hitting a home run, where we would have done money, and yet we've been here. 2008 woke a lot of people up, but a lot of people still don't know the truth behind that. They've all watched The Big Short, etc., but they still don't know the truth. They just see it as it's what happens in the market. This time round, and we've been told by all MSMs, the Gasparinos and I don't even like mentioning their names and give them airtime, but hold them responsible afterwards, because you're going to have all these experts that are on the telly getting paid hundreds of thousands of nice suits, talking down to us like we're all idiots, and insinuating everyone's like 16, 18, living at home with their mum, never had to live in the real world. Blah. Come on now. This is people. These are the same people that the rules and the 1%ers and the stock market has ripped from your 401ks and lied to us. This is blatant lies. This is theft. This isn't just the market and how it works. Dumb money loses money. Well, if you listen to the experts, everyone who bought AMC and only AMC has made a shit ton more than any of them experts have. And yet we're still held out as the ones that are the idiots. And when they want to talk and they want to go on and do their interviews, start talking about the real stuff. Because if you don't, afterwards you're going to have no credibility, because everyone's going to say, we told you. We told you, and you kept telling everyone not to put us off because we was already in it, proved we weren't leaving, proved we weren't going nowhere. You came on MSN to tell everybody else whose money you had, every other investor, everybody who had a 401 and never invested in the market or a share or Apple, who lost their pension now, not because of us, we're the cure, not the cause. You told them that we were wrong and you were right. You told them we were dumb money, and you told them to go and buy Apple because it's going to hit a $3 trillion market, and it tanked. And they're the same people you did it to in 2008. My mum and dad, working 18 hours a day to pay a 17% mortgage because of some greedy bank that we had to bail out afterwards, that we had to have austerity afterwards, we had to suffer afterwards, so that they carried on getting richer, and nothing changed. Damn! You answer that. You tell the people that. You come back and you explain that.
Fuck yeah, that's exactly right.
Goddamn right, brother. Nothing fucking changed. We lost our fucking pensions, 401ks, life savings, our homes, our cars, everything, our jobs. And then we had to give them billions of dollars in fucking bailouts. Fuck these banks. It's our fucking time. $30 fucking. Let's keep it fucking going.
That's right.
Wolfie,
That's
people are
right.
loving it, dude. Everyone feels that shit, dude. 100%, brother. Everyone is giving you so much props, man. You are fucking on point, and everybody knows it, man. No matter what the mainstream media wants to tell others, what they want to preach, I don't give a fuck if CNBC is owned by Citadel. I don't give a fuck that Pfizer owns CNN. We know what's really going on here. So thank you very much for that, brother. By all means.
Appreciate you, brother.
No worries, man. We've got to
Yeah,
speak up for millions that ain't here now. Don't
Because
forget,
nothing
there's
has
people gone
changed.
from that. That
We've been
2008,
allowed the
a lot
opportunity
of innocent people.
to witness
And
the worst
you'll be
market
walking
crash
around. I do it
and
every day.
margin
I've
call
done it every
and
day
short
since
squeeze
January when I bought
in
in. This
history.
was my chance to pay them back. But I walk around and it's like you see the scenes in some of the films when they're driving around in a car. I can't think what the margin called, the film. When he's driving around in that car and he's got the young lad next to him and the young lad's attitude is, I don't give a shit, you know, until he realises he's even going to be paid. But they're looking out the window and they're looking at all the people that just do not know. So if you're going to do things in your community, A1, top of my list, family, A2, top of my list, make sure you get that word out amongst the people you've got, because they call you stupid at day. Look at Burry, he's been wrong more times than he's right, but everyone holds him up as an expert. He sees something that we all see. You know, DFE started this ball rolling in GME, that's going to do its thing as well. You know, all this infighting and stuff, that has to stop, because it's me, you against them, it's not me against you. I mean, how does that work? They want it, we got all the bots arguing with bots and we all jump in on it. No. Start talking about the people that were hurt, the people that have been forgotten. Go and have a look at the Wall Street Conspiracy, the film that they pulled 5 minutes before it was due to air in America. Go and have a look at Darren Saunders walking around with the placards on. That man died fighting what we're fighting today. You know, there's good people that ain't here today. We need to remember them and we need to be loud after this. It's not because we're rich, not because we're arrogant bastards that turned into the people that we're fighting against, but because we care and we want change. We want these fuckers held accountable. Running around in their planes when we can't even go out, can't even visit our mums. Come on now. Change. We need change.
Fuck, man, I will vote for you. Just fucking run.
Wolfie for president.
Bro, for real.
Prime Minister, everything.
Now I'm going to $1 million.
I'd like to note, a lot of people are unaware as to why Evergrande has yet to collapse, as to why it's yet to affect financial markets. And the fact of the matter is that it's because the holders of their bonds and their collateral, and the banks, maintain fair value accounting standards for Evergrande bonds. Therefore, they are still valuing them at what they were worth when they purchased them, not their current value. And when Evergrande goes bankrupt or has to be nationalized, then we will see the true value of this collateral be wiped out to absolute zero. And on that day, my friends, we're going to be so fucking rich.
Cheers.
Cheers, brother. This one's for you, Ken Griffin. I'm going to fucking light it up. Just for you.
Cheers.
Cheers, brother.
J Squad.
I think it's time to blow this scene. Get everybody in the stuff together. Okay, 3, 2, 1, let's go. You're an original, aren't you?
Cowboy.
I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Cowboy.